Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the February investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe you need to know right now. Bob, how you doing?
Doing well, Sammy. How are you?
Pretty good. Cold, but doing okay. Do you have a Super Bowl prediction?
Patriots.
That sounds like more fandom than anything. Do you have an actual prediction of how you think the game will
No.
go?
What do I know about predicting the future? I hope they win, but
I think you and I have to confess because when Jim Scally, our chief culture officer, asked us at the beginning of the year for our Patriots regular season predictions, I don't think we had them with a winning schedule. So probably people shouldn't worry about what we think for this game.
I think my prediction was 5 wins. After the last few seasons, I was pretty down on them, but they've certainly surprised a lot of people, including me this year.
Nice. So pessimistic about the Patriots, maybe not now, but how about the markets? How are you feeling about the markets?
The markets, it's interesting. The big news is Kevin Warsh being named as Fed chairman, which generally positively surprised by as a pick. There's a lot to like about him, but just as an overall candidate, I think he's a good person for the role. But there's also part of his policy can be what they call more hawkish. So markets may not love it. So while he's, I think, a solid person, great background, so I'm pleased with the pick. It does leave a lot of things to think about with markets. So
Bob, can
uh,
you decipher that for our listeners when they read, oh, this guy's hawkish or this lady's dovish, or what does that mean when it comes to Fed policy?
it's put it simply, think gas and brake in a car. Gas, stimulative, go fast. So the gas is dovish. So a Federal Reserve that's dovish is lowering interest rates or more favorable policy, and brake is hawk. So brake is slow things down. So policies that are more restrictive to the economy. Again, like higher interest rates to fight inflation. That's more of a hawkish, so more of a conservative approach as opposed to more, putting fuel on the fire, more dovish friendly.
Is this like perma bulls and perma bears? Like you're always hawkish or you're always dovish? Or wouldn't we want people to, be temporarily one or the other, but, not really have an inkling either way? Are you saying that there are certain people who are, regardless of what's going on, more hawkish or dovish?
It's a mix, but there are some that generally do lean one way or the other. And with Kevin Warsh, where it really comes down is it's pretty nuanced and technical, but we might as well get into it because I think it is really important. The Fed has a dual mandate, so price stability and employment, full employment. So they're looking at jobs and inflation, and they have two tools. The Fed funds rate that we talk about a lot, that the markets, CNBC talks about, you always hear, what are they doing with the Fed funds rate? But that's only one of the tools. The other tool, and one of the reasons why I think it doesn't get mentioned as much is they've only really started using it in a meaningfully way in 2008. So it's a tool that they've kind of created and used more aggressively is their balance sheet. So the Fed uses their balance sheet to buy securities, mainly fixed income securities, treasury bonds, mortgage bonds. And they've been doing that, like I said, since 2008 in a call it bigger and bigger way. So the Fed balance sheet overall has been growing. There have been periods of a balance sheet unwind, but if you look since 2008, the level has increased. And when they buy assets with their balance sheet, that is stimulative because they're owning assets on the balance sheet. And when you buy an asset, what are you doing? You're putting cash into the system. So you're increasing the money supply. You're giving investors collectively more cash. And what do investors do with cash? Well, they invest or they spend. But either way, that's you think that ultimately would be good for assets, asset prices, good for economic activity. But the counterbalance is it can be inflationary. And I bring all this up because Kevin Warsh is not a fan of the Fed's increasing balance sheet. Quantitative easing is the term when it's increasing. He would rather see it like it was pre-2008, where their main tool is the Fed funds rate, and not have the Fed in the business of owning $6 or $7 trillion of bonds, because that's to some extent it's manipulating markets. So he's more of a purist and manage the rate, but don't go around and tinker with the balance sheet. Uh,
Where does the Fed get their money to buy assets to put on their balance sheet?
it's kind of mind-blowing. They just create it. They just go on the computer and let's just deposit $1 trillion. One, add some zeros. Now we have $1 trillion, and you just go out and buy. It literally increases the money supply like that.
But it's not considered part of the deficit.
Well, once they buy assets, it then look, they're buying treasuries, but no, it's
How about when
increasing.
they unwind and sell those assets? Who gets that money?
There's two ways you can let it run off, where the treasuries mature and then the dollars can just go into the balance sheet. So then, but since they bought it from the market, it was they're buying these like secondary issuance, you could say. So it's exchanging hands. It's going from Goldman Sachs to the Fed.
All right. So he is hawkish in the sense that he is not a fan of these balance sheet asset purchase maneuvers.
Right. And there's been a lot of commentary since 2008 that the increasing Fed balance sheet has led to more, you could call it speculative activity in markets. And I do think there's something to that. And you've seen what I would call like froth assets, like Bitcoin, as an example, has sold off recently. Um, and I think it's tied to this, that you flood the system with money from the Fed's balance sheet. What do people do with it? They do things like buy Bitcoin. And if the direction is going to be less of that, then the non-profitable companies, cryptocurrency, things of that ilk have not reacted well since the nomination.
So why would President Trump, who really wanted lower rates, appoint somebody slightly hawkish? Is that because his hawkishness isn't really reflected in his interest rate policy?
So the interest rate policy, it actually is pretty clever. It's lower rates. So
Lower rates because you're unwinding. Another reason to lower rates is because you're unwinding the balance sheet.
lower rates is the gas.
Yep.
So that's stimulative. And I think that's where Trump hears that. He's like, okay, you're hired. That's what I want to hear. But then unwinding the balance sheet's the break. So it actually, in a pretty clever way, they offset. So it could work. If he just picked a puppet who was just like, whatever you say, sir, I'll just put rates to zero and do nothing else, the high likelihood of us having inflation, that would not be good. And that's what people, I think, were afraid of, why gold ran up as much as it did. The concern that we're just going to get a puppet in there who's going to cut rates because that's what the president wants and do nothing else. Uh, Not to insult the president, but maybe he didn't fully understand or care about the balance sheet part of the conversation. It was just like he heard cut rates and said, that's what I wanted to hear. But I think it's a pretty sophisticated playbook, and he's not a puppet candidate. He's a professor at Stanford, went to Harvard, used to serve on the Fed. So he's a sophisticated guy, and he wants to take the Fed back to where it was before 2008, really, as far as just not being so big with its balance sheet in markets, which I do think generally makes sense.
Let me ask you a ridiculous question, Bob. The person who's chairing the Fed, as long as it is a credible candidate, and it looks like throughout this process, the short list of candidates that were aired publicly were all considered credible by the market and different levels of variation. Does it make a difference who heads the Fed so long as you had appointed a credible chair?
As long as it's a credible chair who thinks and operates independently, I would say pretty much no. But I think with the criticism, I would say Powell fits that definition, for sure. And President Trump does not like Powell. That's become clear, and was highly critical of him. So I think there was a growing concern that you have a pool of candidates, but the interview process would sound something like, will you cut interest rates and do whatever I want? Yes, sir. Okay, you've got the job. And as I was saying, alluding to a puppet. and that didn't play out. Maybe that was never a fair concern to have, but just with how harsh the criticism towards Powell has been and the pressure that had been coming towards him to lower rates, I think there was a growing concern that the person who was selected would be just more do what the president wanted and not take into consideration the broader picture that the Fed is supposed to do.
Right. So, I mean, I know obviously in hindsight who you choose as chair and the decisions that well, they're not fully in control either, but that are made under their tenure have tremendous impact. But I was sitting there thinking about, does it really matter in advance? Does the market get it right in advance when they pick these candidates? And, does it ultimately, matter at this stage, or does it matter later when we're looking back at the decisions that they made? So the good news for investors is the market can give us a second to second scorecard on decisions like this. So based on market reaction so far, what are you interpreting this selection to be saying?
Yes, well, I'll just run through year-to-date returns. This is as of February 2nd. So US stocks, MSCI USA up 1.78%. But there's an interesting split. Right away to get to your question, MSCI USA value, so the value part of the market up 5.14, MSCI USA growth negative 1.61. So overall up, what I say, about 1.8%, but value's up rounding 5%, growth is down close to 2. And this gets to what I was saying. If there's an unwind of the balance sheet, that taking money out of the system, investors start to take their calculators out and be a little more serious with how they're allocating dollars and want to see things like income and dividends. And that speaks towards value and less lottery ticket investing. Looking overseas, MSCI World ex USA net total return up 4.3%. So strong from developed international stocks, and emerging markets even a little better. This is the MSCI Emerging Markets net total return up 6.4%. So 2025 was a good year for foreign equities, and they're continuing to perform so far this year, only being about a month in. But those are quite healthy returns in a month. And bonds are basically flat. The aggregate index is down a basis point. So I didn't talk about this with the Warsh policy. And this is just hearing what he's been saying and trying to interpret it. But if you have a lower Fed funds rate, if you think about the yield curve is like, think treasury yields of different maturities. You could have, 1 month T-bills going all the way out to 30 years and spots in between. With a lower Fed funds rate, you would have a lower rate on the short end of the curve. But if they are not holding and buying longer term treasuries, they're more leaving that to the market to price them. So you're seeing a yield curve, what they call steepener, where the long end would go up and the short end would go down. We've had a pretty flat curve because short rates were pushed up high through an elevated Fed funds rate, and the market was expecting cuts. So the rates were pretty much about the same, around a basically flat line of 4%, whether you're buying T-bills or 30-year bonds. And we've seen a market reaction where the long end's going up, less Fed involvement, and the short end's going down, expecting rate cuts. So as far as the bond returns, the aggregate index, it's felt some of the pressure on the long bonds going up because there's more price sensitivity. And for consumers thinking about, well, what does this mean for me? Like, what does this mean for mortgage rates, as an example? It's not necessarily, well, he's going to cut rates, so mortgage rates will go down. Mortgage rates are frequently tied to intermediate to longer term bonds. So that is more of how the market will react. So that you could see rate cuts with rising mortgage rates, as an example, if intermediate to long term rates go up.
So you periodically look at market odds for rate cuts. What is the market telling us is coming, and has it changed since this appointment?
Yeah, that's a good question. So looking out, let's go mid 2027. So June 2027, the base case is about a 50 basis point rate cut from where we are now. I don't think it's changed very much. Market had been pricing in a couple of cuts, so it's not like this was a big change. I think the market was counting on a candidate who would cut rates, and even Powell has been cutting rates. So the on that side, it's not that big of a difference. It's more the balance sheet part of the Fed role that's the story here. But yeah, looking at 3 to 3.25 is the probably most likely outcome implied by futures in June. And then if you go to December, it's actually still 3 to 3.25. So they're just looking at a couple of cuts. But it put a big asterisk. I do find it interesting to look at this. This is how markets are pricing, but the market has been terribly wrong as far as pricing where the Fed funds rate is going to be, over the last 5 to 10 years. And I think we've talked about this previously. Part of it, I do think, is the market prices in something, and then if it's expecting, call it a dovish Fed, an accommodative Fed, Fed's going to cut rates, the market prices it in. Bond investors price it in. What do stock investors do? They price it in. How do they price it in? They get all excited and push stock prices up, and then you have an economy that's too hot, and you don't get the cuts. And vice versa. If you're expecting rate increases, everyone gets concerned. Oh, they're going to raise rates, and things slow down, and then you don't need to raise rates. So it's not just that the market's run by a bunch of buffoons who don't know how to price assets. There's a circular, function where if you price in a lot of optimism, you may not need it, and vice versa. So it's good to see how the market digests things, but don't take this as that's the newspaper 6 months from now because it frankly has a big margin of error.
So what would be the case to cut rates anyway if the economy is doing well? Is it still the labor market?
It's the labor market, like the JOLTS report, job opening labor turnover survey came out recently, and we're down to 7 million job openings, like 7.0 million, which is on the lower end since COVID. It's been declining month over month. The unemployment report, the last one did have a decline in unemployment as well. I think it went from 4.6 to 4.4, so that was good news. So it's mixed there with unemployment going down, but JOLTS also going down. So that would be really the concern that if there's weakness in labor combined with inflation just not being a concern, you could make a case for cutting rates. But I think that's why the market's saying maybe you cut it 50 basis points from here, but we're basically done. We're close to equilibrium.
Do you think we're still late cycle in the economy, or is it just hard given this conversation that we've had about this and this K-shaped recovery that people are, or not recovery, K-shaped economy that people are talking about? You can look at certain data points and think things are better than they are or worse than they are. Where do you think we are in the market cycle?
Yeah, I think we are pretty late. Part of it depends how you think about 2020. While I think it was technically a recession, I wouldn't count that as one. With the government stimulus, it was a blip. There weren't many bankruptcies then, and I view it as we've been in an expansion since 2008, call it 2009 when it really started. Um, Unemployment got down pretty low into the threes. We haven't had call it a good recession. Not that there's such a thing, but a healthy one maybe where investors learn their lesson for getting over their skis, and you have some weaker companies go out of business. Like we just haven't had that. That's a good thing. Those times aren't fun, but we've had quite the expansion as far as stock market returns have been incredibly strong. Unemployment has been very low for a while. And I do think a lot of the speculation, the things like we've seen with crypto that I've mentioned, some of the tech companies getting, I think, pretty darn expensive. It's been a good time to be an investor. And markets do tend to cycle. So as we've been saying, be diversified, have, an adequate savings account, just common sense investing. Don't get too excited in these markets and chase returns.
Yeah, I ask you because I find it confusing. Late cycle, you wouldn't necessarily be cutting rates, right? Late cycle, things can get overheated, and now you're talking about whether you need to increase rates. But we did have COVID, which was this kind of artificial, environment for a lot of reasons. Then you had the inflation spike where rates went up, and now they've kind of come back down. So it is maybe harder for me to assess where we are in the cycle, and when we'll get back to more normalized things. But I do get a little confused about why we would be cutting rates if the economy's doing well and we're late cycle. And so it's just something I guess you shouldn't be trying to time around, but if you're just trying to understand the environment that you're in, whether you're a business owner or from a financial planning purposes, it's gotten a little confusing, I think.
Yeah, the saying history doesn't repeat itself, but it rhymes. We're certainly in more of the rhyming category here where we haven't seen this play out before. And I'd add AI. I think artificial intelligence is going to be a game changer, and how it impacts jobs will be very interesting to see. I think it's already happening. And that's where you have the potential to have a very unusual outcome where you have strong corporate growth, profits, earnings, productivity, but you have weak employment. Typically, those two are tied at the hip, where companies are doing well and they're employing more and more people, or vice versa. But we might be seeing earnings look good, growth looks good, but unemployment doesn't, and it's a head scratcher. But if you start employing more robots than people, that's what it could look like. So that's also something we've never had to deal with in history before, and how you navigate that. So that's telling in the employment data, and something I'm watching closely.
Bob, if I could replace you with an AI podcast co-host, I wouldn't. I just want you to know that
Oh,
your job is safe. It doesn't pay much, but your job is safe. What one thing we haven't invested a lot in recently allocated to are foreign bonds, and I know we might be looking at that regardless of whether we do or we don't. What are kind of what's the case to own them? What's the case for why people wouldn't own them? What's a primer on foreign fixed income? And are we talking foreign corporate or foreign government? Like, is there a distinction? How do you think of that?
yeah. So with bonds, there's two main risks: interest rate risk and credit risk. So credit risk, you buy a blockbuster bond, thinking people are going to rent VHS cassettes forever, and they go bankrupt, and you lose the money that you lent to Blockbuster through a bond. That's credit risk. And then interest rate risk is more price sensitivity, where you buy a 10-year bond at 2%, and then rates go up, and now the price goes down because the bond has to price into the current market yield. When you build a portfolio for an end investor, you should tend to keep credit quality higher. You shouldn't have a lot of blockbuster bonds in there, is my point. Meaning the main risk should be interest rate risk. So then if you're thinking about it from an allocator seat, okay, I don't want to buy a bunch of junk bonds. That wouldn't be responsible. But I am going to have interest rate risk. You have the risk that something happens, say there's a change in the Fed chair, and the new chair favors policies that could lead to higher long-term rates. All of a sudden, interest rate risk in the US is something that might be flashing yellow on your dashboard. So why international bonds? The main case is to have different yield curves in your portfolio. Jump into what you're talking a third question, mainly government bonds, but also could be investment grade corporate bonds, even US companies issuing in foreign currencies. Like you can have a McDonald's bond issued in yen, as an example. But what happens is you then don't just have the US yield curve in your portfolio. You have, I just said Japan, so then you have the Japanese government bond yield curve in your portfolio. And if interest rates go up in the US, say the 10-year Treasury yield is increasing because of policy decisions that are made in the US, that doesn't necessarily mean the 10-year Japanese government bond yield is going up. And then you're getting diversification across yield curves. So you lessen your dependence on any one country, specifically the US, because that's by default where US investors would invest their fixed income. So it's mainly a yield curve diversification story. You can add, if you do emerging market debt specifically, you get higher yields typically. So you can get a little more yield, but that also comes with more risk. But it's a different way of doing it, where you're getting more diversification, more exposures, more credits, and in that little example, the higher yields. But generally, it's the yield curve diversification is the main point for doing it.
And in exchange for that, you're exposing your portfolio or to more currency risk then, or?
Yes and no.
Right.
Sometimes they're issued in foreign currency, sometimes they're issued in US dollars.
Okay.
So you can buy foreign bonds that are in dollars but tied to the foreign curve, and or you can hedge back to the dollar. So it does get complicated. There's a lot of ways to do it. When we've looked, currencies can be volatile and bond yields are relatively low to the point where, a currency can move 10% a year easily and the yields aren't 10%. So if we were to invest in foreign bonds when we've gone down that path, an unhedged local currency approach is not something that we would do much of, if any, because your primary driver is going to be the currency, not the yield. So we'd be either doing dollar issued or dollar hedged. Mostly, would we let some local in there? Possibly, but mostly we'd want to neutralize the currency risk because it's too large in fixed income.
And this would be more of a satellite holding, a smaller fixed income position as part of a broader allocation.
Yeah, I think like of your fixed income, 80/20, 70/30, and that ratio being the percent in the US being 70 to 80% and the foreign being 20 to 30. I think th those are reasonable mixes. So that's something that we've been looking at and may end up doing.
Okay. So I'll get you out on this one, Bob. The market has been fairly calm, not a lot of volatility, trending upwards. How are you explaining the market to people that you're talking to in our client meetings and in your personal conversations? Are you apprehensive? Are things too calm, or is this what a market looks like most of the time and we should just enjoy it?
Yeah, no, that's a good question, and but maybe a slightly different version of that's come up is: are we in an AI bubble? I have
Mm.
received that a few times. That's been in the
Yep.
news, and the way I think of it is it probably is like the late '90s, where you are seeing big changes in technology, and I do think, as I mentioned minutes ago, I do think AI is going to it's going to be big and change companies. And the hard thing is to time it. And in the late 90s, a lot of money was made in stocks. And there were very, highly regarded investors who were saying this is a bubble, it's too expensive in 1996, 1997, when those were great years to invest in, great years followed those years to invest. That bubble didn't burst until March of 2000. So we're somewhere in that window, and I know it's not a satisfying answer, but the more the point is, the returns will very well may be quite strong for a while until they're not. So the whole idea of like be all in or be all out, I just would not advise that. We've had a couple of good years in a row. This year so far is looking overall good for a globally diversified portfolio, but it's more just the advice of you want to participate, but participate to the right amount. So if say 60/40, 60 stock, 40 bond, just because that's a classic ratio, I'll use that as an example on the podcast. If that's around where you should be, then long term, that's where you should be. Then I would be around a 60/40. And maybe if you want to underweight equities a little bit, just to be a little more cautious because we've had such a good run and be 55/45, that might be appropriate. But that's about the extent of it. That in these markets, when technology is changing the world, they can go for a while. So it's just tough to time the market. So don't try.
Great advice. Thanks for taking us out on that, Bob, and thanks for your recap of what's going on in the markets. I know our listeners always enjoy hearing directly from a CIO who's in charge of these things.
All right. Thanks, Amy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kushal Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.